Hey everyone, and welcome to another deep dive.
Oh, yeah.
You're here because you want to master those retirement saving superheroes, the 401k and the IRA.
Huh.
Am I right?
You got it. We're going to break down these retirement plans so you can really take control of your financial
All
future.
right, so let's start with the 401k. Now, this one's usually connected to your job, right? What's the main perk?
Well, the big draw for many is that employer match. It's basically free money to help you save more. Let's say your employer matches 50% of what you put in up to 6% of your salary.
Yeah.
If you're making like $60,000 a year and you contribute that full 6%, that's $3,600 from you. With the match, you're getting an extra $1,800 from your employer just for saving for retirement.
Wow, that's a pretty sweet deal. It's like an instant 50% return on your investment. I'm starting to see why people love these things. So what else is good to know about 401k?
Well, in 2023, the max you can contribute is $22,500 or $30,000 if you're 50 or older. And another key thing is that these contributions come out of your paycheck before taxes. So if you contribute like $5,000 to your 401k and you're in the 22% tax bracket, you're saving $1,100 in taxes right now.
Gotcha. So those pre-tax contributions can really add up.
Mm.
But hold on, I've heard 401ks don't always have the best investment options. Is that true?
That's a good point. They usually offer a limited selection of mutual funds, which might not be the best for someone who wants to be super hands-on with their investments.
So maybe not ideal if you want total control over where your money goes.
Exactly. But remember, you don't want to miss out on that employer match if you can get it.
Right. Free money is free money.
Yeah.
Okay, so let's move on to IRAs. What's the big deal with these?
IRAs are all about individual control and flexibility. They're great for anyone who's self-employed freelancing or just wants more options for their retirement savings.
And there are different types. So
You got it. You have the traditional IRA and the Roth IRA. With a traditional IRA, you might be able to deduct your contributions from your taxes depending on your income and whether you already have a 401k at work.
So kind of similar to the 401k in that you might pay less in taxes now.
Right. Your money grows tax deferred, and you pay taxes when you take it out in retirement. But then you have the Roth IRA, which is kind of the opposite.
Ooh, tell me more about the Roth IRA. I keep hearing how awesome it is.
Well, with a Roth, you contribute after-tax dollars, but here's the kicker. Your money grows tax-free, and you don't owe any taxes when you withdraw it in retirement.
Wow. So you pay taxes now, but enjoy tax-free withdrawals later. That sounds pretty amazing, especially if you think you'll be in a higher tax bracket down the road.
That's the idea. You're essentially locking in today's tax rates for your future withdrawals.
Pretty smart.
Hmm?
But is there a catch? The Roth sounds too good to be true.
Well, there is a lower contribution limit. It's
Yeah.
$6,500 or $7,500 if you're 50 or older. And not everyone can deduct the full amount with a traditional IRA. It depends on things like your income and whether you have a 401k at work.
Gotcha. So there are some trade-offs to think about, but still a great way to save for retirement. And I've also heard IRAs give you more flexibility with investments. What's the deal with that?
With an IRA, you can tailor your portfolio to your own goals and risk tolerance. You can invest in all sorts of things like individual stocks, bonds, real estate investment trusts, even precious metals.
So you're not limited to just a few pre-selected mutual funds like with some 401k.
Nope. You have a lot more freedom to choose how your money's invested.
That's awesome. All right, so we've got the 401k with that potential employer match and pre-tax contributions. And then we've got the IRA with its flexibility and the possibility of tax-free withdrawals. It's like picking between two delicious desserts.
I like that analogy. And sometimes you don't have to choose. You can actually contribute to both a 401k and an IRA in the same year.
Whoa! Double the savings, double the retirement fund. I like the sound of that. But how do you actually decide which one is right for you? What are the main things to think about?
That's a great question. Well, first off, does your employer offer a match with their 401k plan?
Okay.
If so, it's often the best place to start because that free money from your employer is hard to beat, even if the investment choices aren't as broad.
Right. Free money is always a good starting point. So what if your employer doesn't offer a match or you've already maxed out your contributions?
Then you want to think about your taxes. Are you in a high tax bracket now, or do you think you'll be in a higher one when you retire?
Okay.
If so, a Roth IRA might be the way to go because those withdrawals in retirement will be tax-free.
So pay taxes now and enjoy the rewards later. Makes sense. What if you're more focused on lowering your tax bill right now?
Then a traditional IRA or 401k might be better. Those pre-tax contributions can make a big difference in your tax bill today.
Got it. So it really depends on your own situation and goals.
Exactly. There's no one right answer for everyone when it comes to retirement planning.
Now, before we move on, I'm curious. Is there anything in your own retirement planning that you found especially helpful or surprising?
I used to feel kind of intimidated by investing, but once I started learning about asset allocation and how to build a diversified portfolio, it all became much clearer.
Asset allocation. Could you break that down for our listeners?
Sure, it's basically the strategy of dividing your investments among different asset classes like stocks, bonds, and real estate. It helps to spread out your risk and potentially increase your returns over the long haul.
So not putting all your eggs in one basket, as they say.
Exactly. Diversifying can help you handle those ups and downs in the market a little more smoothly.
That makes sense. And it sounds like that applies to both 401ks and IRAs, right?
Absolutely. Whether you're choosing investments within your 401k or building a custom portfolio in your IRA, asset allocation is a key principle.
Okay, that's super helpful.
hmm
I'm already feeling more confident about planning for retirement.
Awesome. Knowledge is power, and the more you know, the better choices you can make.
All right, so before we go deeper into all of this, I have a quick question. We've talked about the different types of accounts and the tax benefits, but what about the money itself, the money that's actually growing in these accounts?
You're talking about compound growth. It's one of the coolest things about investing for the long term.
It does sound kind of magical. How does it actually work?
Imagine you invest $1,000 and you get a 7% return in the first year. So now you have $1,070.
Okay.
In the second year, you earn 7%, not just on your original $1,000, but on that $1,070. So your money is basically earning interest on top of interest, and it grows exponentially over time.
I see. So it's like a snowball rolling downhill, getting bigger and bigger.
Exactly. And the sooner you start investing, the more time that snowball has to grow. Even small, consistent contributions can turn into a significant nest egg eventually.
Wow. So compound growth is our friend. But what about when the market goes down? How do we stay calm when things get a little shaky?
That's a great question. Remember that market fluctuations are completely normal.
Okay.
Instead of checking your account balance every day, focus on the long-term trends.
So don't panic sell when things dip down.
Exactly. Trying to time the market is really hard even for the pros. Just stick to your plan, maintain a diversified portfolio, and ride out those temporary storms.
It's like remembering that the stock market is a roller coaster, but the overall trend is upwards over time.
You got it. Having a solid investment strategy and a long-term perspective helps you stay focused through those inevitable market ups and downs.
Great advice.
Yeah.
Now let's talk about something people sometimes forget about taxes in retirement. We talked about the tax advantages of 401ks and IRAs, but are there any strategies for minimizing taxes later on?
There are definitely some things you can do. One approach is tax diversification. This means spreading your retirement savings across both tax-deferred accounts like traditional 401ks and IRAs and tax-free accounts like Roth IRAs.
So it's like having a balanced portfolio, not just of investments, but also of tax treatment.
Exactly. This strategy gives you more flexibility in retirement. You can choose to withdraw funds from different accounts to manage your taxable income.
That's a smart way to potentially lower your tax bill when you're retired. Any other tax saving tips?
Another strategy is to wait a little longer to start taking your Social Security benefits.
Tell me more.
You can start receiving benefits at age 62,
Yeah.
but your monthly payments will be smaller. If you wait, your benefit amount increases each year.
So delaying Social Security could mean bigger checks later on.
Right. This can be a nice boost to your retirement income, especially if you're healthy and expect to live a long life.
That's a good tip.
Ugh.
I'll keep that in mind as I get closer to retirement.
And remember, tax laws can change, so it's always a good idea to stay updated and maybe talk to a financial advisor as you get closer to retirement.
Definitely. Professional advice is always helpful. Well, I think we've covered a lot of ground here today. What are some key things for our listeners to take away?
Well, we've learned that both 401ks and IRAs are great tools for building a secure retirement. The key is to understand their unique features and pick the right one or combination that fits your own situation and goals.
And don't forget, the earlier you start saving, the better, thanks to the power of compound growth.
Absolutely. And don't be afraid to get some professional advice if you need help navigating the world of retirement planning.
Great point. Well, that wraps up the first part of our deep dive.
Right.
We've laid a solid foundation, but there's much more to explore.
Stay tuned for part 2, where we'll reveal some advanced strategies to help you take your retirement planning to the next level.
It's going to be good. Welcome back. Ready to dive deeper into those retirement savings powerhouses, the 401k and the IRA? Last time we covered the basics, but now let's talk strategy.
That's right. We're going to level up your retirement planning game.
All right, let's start with those 401k. Any pro tips for maximizing our savings with those?
One strategy is to slowly bump up your contributions over time.
You mean like gradually increasing how much I'm saving without feeling a huge hit to my budget.
Exactly. You could start by contributing, say, 3% of your income and then increase it by 1% every year maybe when you get a raise or a bonus.
That way you're boosting your savings without really noticing the difference.
It's a small change, but it can make a big impact in the long run.
Got it. So we're talking small steps towards a big retirement goal. Now, what about the investments inside a 401k? Any advice on making those contributions work smarter?
Absolutely. A lot of 401k plans have these things called target date funds. You can think of them like setting your investments on autopilot.
Autopilot for retirement savings. Sounds interesting.
So these funds adjust the mix of investments as you get closer to your target retirement date. When you're younger, they might invest more heavily in stocks for growth potential, but as you get closer to retirement, they'll automatically shift to a more conservative approach to help protect your savings.
It's like having a built-in financial advisor for your 401k. That's pretty cool. Now, what about IRAs? Any secret weapons we could use to make those work even harder for us?
One tactic that's getting popular is the backdoor Roth IRA conversion. This is especially useful if you're making too much money to contribute directly to a Roth IRA.
Backdoor Roth. That sounds kind of sneaky. In a good way. I mean,
Yeah.
how does it actually work?
Well, you start by contributing to a traditional IRA, which doesn't have those same income limits. Then you convert that money into a Roth IRA.
So you're basically taking a detour to get to that Roth IRA destination.
Exactly. You might have to pay some taxes on the conversion, but ultimately you're setting yourself up for tax-free growth and withdrawals when you retire.
Pretty clever way to get around those income restrictions. Okay, so we talked about contribution limits earlier. Any way to sneak in a little extra savings?
Definitely. If you're self-employed or have some side income, there are some special options just for you.
Ooh, side hustles are all the rage these days. Tell me more.
Well, there's the solo 401k, which is awesome for entrepreneurs. It combines elements of a traditional 401k and a profit-sharing plan, so you can contribute as both an employee and an employer.
So you can contribute more overall.
You got it. It's a great way to turbocharge your retirement savings.
That's awesome. What if you're not quite ready for a solo 401k, though?
Then there's the SEP IRA, or Simplified Employee Pension. It's another option designed for self-employed folks and small business owners, and it lets you contribute more than a traditional IRA.
So it's like a secret weapon for people who are building their own businesses.
Exactly. These specialized plans give you some serious advantages for saving more for retirement. Now let's talk about investment strategies within an IRA. We mentioned earlier that you have a lot more choices with IRAs. Any tips for navigating all those different options?
That's definitely an area where I feel a little overwhelmed. There are just so many choices.
It's all about finding the right mix for your own needs and goals. And a key concept here is asset allocation.
We talked about that a little bit before, right? Spreading your investments across different types of assets.
Exactly. Think about stocks, bonds, and real estate. Stocks have the potential for big growth, but they come with more risk. Bonds tend to be more stable, but they might not grow as much. And real estate can give you diversification and potential for both income and appreciation.
Okay, so it's like building a team of investments with each player bringing their own strengths.
I like that. And how you split your investments will depend on things like your risk tolerance, how long you have until retirement, and your financial goals.
So someone who's younger might be more comfortable having more of their portfolio in stocks, while someone closer to retirement might prefer a larger chunk in bonds.
Exactly. It's all about customizing your investment strategy to your own situation and goals. There's no one-size-fits-all approach.
That makes sense. So we've talked about asset allocation, but what are some other investment strategies we can use within an IRA?
You can certainly look into individual stocks and bonds, which gives you direct ownership and control. But for a lot of people, mutual funds and exchange-traded funds, or ETFs, offer a more diversified and manageable approach.
I've heard of those, but what's the difference between a mutual fund and an ETF?
A mutual fund pools money from a bunch of investors and uses it to buy a bunch of different assets like stocks or bonds. They're run by professionals and offer a convenient way to diversify your investments.
So it's like having a team of experts manage your money for you.
Pretty much. ETFs are similar to mutual funds, but they're traded on stock exchanges just like individual stocks. This can give you more flexibility and potentially lower costs.
So both are good for diversification, but ETFs might be better if you want more control and lower fees.
That's a good way to look at it. The best choice depends on what you're looking for in your investment goals.
Awesome. All this is making me feel way more confident about investing in my IRA. And I know we talked about compound growth earlier. Can you give me a real-life example of how that actually works?
Sure. Let's say you start investing just $200 every month when you're 25 years old, and you earn an average of 7% per year. By the time you hit 65, you'll have over $450,000.
Wait, $450,000 just from putting in $200 a month? That's amazing.
It really shows how powerful compound growth can be. Now imagine someone who starts investing the same $200 a month, but waits until they're 35. By 65, they'll only have a little over $200,000.
Wow, so starting just 10 years earlier makes a huge difference.
Huge! Those early years of compounding are super important. Even if you can only invest a small amount, starting early is key.
I'm definitely motivated to prioritize saving for retirement now.
That's the spirit. Remember, even small, consistent steps can get you big results in the long run.
Okay, so we've talked about growth, but let's be real, the market doesn't always go up. How do we deal with those inevitable dips and stay on track with our retirement plan?
That's where it becomes even more important to focus on your long-term goals and stick to your plan. Market fluctuations are normal, and historically, the market has always bounced back.
So don't freak out and sell everything when the market drops.
Nope. It's almost impossible to perfectly time the market, even for experienced investors. Just keep your portfolio diversified, ride out those temporary dips, and you'll be fine.
It's like riding a roller coaster. There'll be ups and downs, but you're in it for the whole ride.
Exactly. Having a solid investment strategy and keeping your eyes on the long-term prize will help you stay calm and on course through all the market's twists and turns.
Great advice. Now let's talk about something that often gets overlooked, taxes in retirement. We talked about the tax perks of 401ks and IRAs, but are there ways to actually pay less in taxes later on?
Absolutely. One approach is tax diversification. This basically means having a mix of tax-deferred accounts like traditional 401ks and IRAs and tax-free accounts like Roth IRAs.
So it's like diversifying not just your investments, but also how they're taxed.
Exactly. This strategy gives you more options in retirement. You can choose which accounts to withdraw from to manage your taxable income.
Clever way to potentially lower your tax bill when you're retired.
Yeah.
Any other tax-saving tricks up your sleeve?
Another strategy is to wait a bit longer before you start taking Social Security.
Oh yeah, we touched on that earlier. What's the benefit of waiting again?
Well, you can start collecting benefits as early as 62, but your monthly payments will be lower. If you wait, your benefit amount goes up every year. You delay.
So patience pays off when it comes to Social Security.
It can, especially if you're healthy and expect to live a long life. Delaying those benefits can really boost your retirement income.
That's good to know. I'll definitely keep that in mind.
And one more thing to remember, tax laws can change. So it's always smart to stay informed and maybe chat with a financial advisor as you get closer to retirement.
Getting expert advice is never a bad idea. Well, I think we've covered a ton of useful information today. What are some of the key takeaways for our listeners?
We've learned about some great ways to supercharge your retirement planning, like gradually increasing your contributions, using target date funds, considering a backdoor Roth IRA conversion, and diversifying your investments.
And let's not forget those special plans for self-employed folks like the Solo 401k and SEP IRA.
Right. Remember, retirement planning isn't just about saving money. It's about making smart investment choices to create a future where you can do what you love without worrying about money.
I'm feeling way more confident about my own retirement plan now. Thanks for sharing all this great advice.
Happy to help. Remember, knowledge is power, and the more you know about retirement planning, the better decisions you can make.
Couldn't agree more. Now, before we move on to the final part of our deep dive, is there any particular financial advice you've received that really stuck with you or changed how you think about money?
Early in my career, someone told me, don't wait to invest until you have a lot of money. Start small and be consistent. That advice really clicked for me and helped me shift my mindset from thinking I can't afford to invest to I can't afford not to invest.
That's such a good point. You don't have to be rich to start investing. It's about making those small, regular contributions that can really add up over time.
Exactly. And that's what we're all about here, helping you take control of your finances and build a brighter future.
And we're back for the final stretch of our deep dive into all things 401k and IRA. We've talked about the basics. We've uncovered some seriously smart strategies. Now it's time to talk about avoiding those retirement planning pitfalls.
That's right. Let's make sure you can steer clear of those financial potholes and cruise smoothly towards a comfortable retirement.
Avoiding potholes. I'm all for that. So what's the first pitfall we need to watch out for?
Well, one of the biggest mistakes is simply waiting too long to start saving.
Oh yeah, procrastination. I guess it can be tempting to put it off when you're younger and have other things to worry about.
For sure. But the truth is, the earlier you start saving, the better. Time is your best friend when it comes to building a retirement nest egg.
We talked about compound growth before. How does that tie in with starting early.
Compound growth is all about earning interest on your interest. And those early years of compounding are super powerful. Even small, consistent contributions can grow into a huge amount over time.
So even if I can only save a little bit right now, it's better to start now than wait until later.
Absolutely. Think of it like this. The best time to plant a tree was 20 years ago. The second best time is today.
Love that analogy.
Well,
Okay, so no more procrastination. What other pitfalls should we be aware of?
another common mistake is not taking full advantage of those employer matching contributions in your 401k.
Right, that's like leaving free money on the table.
Exactly. If your employer offers a match, make sure you're contributing enough to get the full amount. It's basically an instant return on your investment.
Free money is always a win.
Yeah.
So we've got procrastination and missing out on employer matches. What else should we watch out for?
Investment fees can really sneak up on you. High fees can eat away at your returns over time, so be fee conscious.
So it's like a hidden cost of investing.
Kind of, like a silent thief chipping away at your savings. Make sure you check the expense ratios on your investments, whether they're in your 401k or IRA.
Okay, expense ratios.
We got it.
What should we be aiming for there?
Generally lower is better index funds, and ETFs usually have lower expense ratios than actively managed mutual funds.
So basically look for investments that are cost-effective as well as aligned with my goals.
That's the idea. Every dollar you save on fees is a dollar that can stay invested and potentially grow over time.
Makes sense. All right, so we're avoiding procrastination, maximizing those employer matches, and keeping an eye on fees. Anything else?
Another big one is withdrawing money from your retirement accounts before you actually retire.
Right, those early withdrawal penalties can be pretty steep. What makes it such a bad idea?
Not only do you get hit with penalties and taxes, but you also lose out on potential growth from compound interest. It's like taking a step backwards.
So those early withdrawals can really sabotage your retirement plans.
They can. Definitely try to resist the temptation to tap into those retirement funds before you need them.
Okay, resisting temptation noted. Anything else we should keep in mind?
We talked a lot about diversifying our investments, but it's also important to diversify your income sources for retirement.
So don't just rely on my 401k and IRA.
It's smart to have multiple streams of income. Think about Social Security pensions, or even rental income if you have property.
So like a safety net of income coming from different places.
Exactly. Diversifying your income can help you create a more stable and reliable retirement plan.
That's a great point. Now I want to switch gears a bit and talk about something that doesn't always come up when we talk about retirement estate planning.
That's a good one. People often forget about estate planning, but it's super important for making sure your assets are handled according to your wishes and that your loved ones are taken care of.
So it's not just about saving for ourselves, it's about taking care of our families too.
Exactly. Things like having a will, a power of attorney, and a healthcare proxy can give you and your loved ones peace of mind.
It's like making sure your financial story has a happy ending.
I like that. And one last reminder, retirement planning isn't a one-and-done thing. It's something you need to keep an eye on.
So it's not like setting it and forgetting it.
Definitely not. It's smart to review your plan regularly, maybe adjust your contributions or investments, and don't hesitate to talk to a financial advisor if you need help.
Makes sense. Like getting a regular financial checkup to make sure everything is running smoothly.
Exactly. Life throws curveballs sometimes, and your retirement plan should be flexible enough to adapt.
Wow, this deep dive has been packed with insights. We've covered so much from the basics to advanced strategies to avoiding common pitfalls.
Yeah. We've given you the knowledge and tools to really rock your retirement planning journey.
And as we wrap up this epic three-part deep dive, we want to leave you with this thought. Retirement planning is about more than just numbers and spreadsheets. It's about designing the life you want to live in retirement and making it happen.
It's about freedom, flexibility, and pursuing your passions without financial worries.
So remember, the future is yours to create. Go out there, use what you've learned, and embrace this exciting journey.
And don't forget the power of those small, consistent steps. Even if you can only save a little now, starting early and sticking with it can make all the difference. Happy saving.
Thanks for joining us on this deep dive into the world of 401ks and IRAs. We hope you're feeling empowered and excited to build a secure and fulfilling retirement for yourself.